While the bulls are cheering, the Fed's second pause in a row is now actually the time to increase risk. As Bank of America's Michael Hartnett points out, investors would typically want to sell the last hike. Why? Because all signs are pointing to a recession on the way. We saw a bigger than expected jump in weekly jobless claims today, that poor ISM manufacturing report yesterday, and our own Bob Pisani flags that fourth quarter earnings estimates are dropping fast. But that's not discouraging my next guest. He's turning to one of the most rate sensitive sectors for opportunity. We're talking about housing, and he's got two names he likes for the long term. Joining us is Charlie Bobrinskoy, Vice Chair and Head of the Investment Group at Ariel Investments. Good to see you again, Charlie.
Hello, Callie. Good to see you.
I can see you bristling a little at my litany of poor things going on in the economy. How would you read the tea leaves?
Well, I think importantly that there are some sectors that have already started to feel some pain. In general, we've been pretty bullish about the outlook for the economy. The bond market's been telling us we're going to have a recession. We didn't think we were going to have a recession. But one area that has felt a recession is housing. And as a result, there are a lot of stocks in the housing sector that have felt the pain of a 5% 10-year treasury. And those housing stocks, housing supply stocks are very cheap in our opinion. This has been a brutal 3 months for value investors like myself, but we do think that we're at the end of the Fed raising process and that we could be having a better environment going forward.
Dwell for a second on what you mean by it's been a brutal period, because it would seem that this has been the tough period for growth investors.
The small cap value index actually underperformed even the S&P, and my prediction had been that higher interest rates would be very hard on growth stocks because those earnings are far off into the future. That turned out to be true, but unfortunately that higher interest rate really took its toll on cyclical stocks. People felt that a 5% 10-year would result in an 8% mortgage rate and that was going to be very tough on housing. And so, again, those value stocks were hit hard.
And let's talk about some of these housing plays like Mohawk and like Generac. These are not home builders per se. And Generac, by the way, what a week all of a sudden that stock's having, although, again, what a tough stretch it's coming off of. Why not the home builders? Those stocks, as we've noted, were much cheaper, 18 months ago than they are now. So dig a little bit into how and where you'd be playing the housing market.
Yeah, mostly it's because the home builders business has actually not been that bad. They have actually held in better because there's so much demand for new housing. What's come way down is repair and remodel. And obviously there was a fair amount of spending in that space in COVID when everybody had to stay home. They decided to improve their library, maybe build a deck, maybe build a pool. That has come down. And again, the prospect of an 8% mortgage rate has meant that people weren't going to borrow to upgrade their own home. We think going forward that there's still a lot of pent-up demand for housing, and when people can't buy that new house, they will repair their own so that they can stay in their current mortgage. But right now, the market is predicting very tough times for housing in the next quarter, and the stocks were hit very hard.
So you're in this for the long run?
Yeah, and we're in this because we are in an unnormally high mortgage rate. So we've got right now real rates that are way over historical averages. The real rate of interest after inflation has averaged about 1% over the last 100 years, and it got to over 2.5%, particularly in the 10-year. And so we think that's going to come down as the Fed has been selling bonds, has been allowing bonds to mature. There's a lot of focus on them taking up short-term rates, but what's just as important is they've been selling bonds, and about $1 trillion worth of bonds. And that's put huge pressure on long-term interest rates. We think those are going to come down over the next year.
You think the long-term interest rates are going to come down over the next year?
As the Fed stops tightening. Again, they sold $1 trillion worth of bonds. They aren't going to do that going forward. When it was the Fed buying bonds that sent interest rates down to those unsustainably low levels back in 2020 and 2021. Over the last year, this hasn't gotten the publicity it deserves. They've sold $1 trillion worth of bonds, and that is a big reason why rates went up to 5% in the 10-year. We think that is going to stop, and when they stop selling bonds, we'll get a normal 10-year, which I'll call 4%, which would help a lot.